In this lesson, we're going to go over the rest of the differences between accounting for a merchandise business, in other words, one that sells goods, versus a service business. And there's not many differences. They're essentially here in the accounting cycle. You've already talked about sort of the concept of inventory and what it means for cash flow and why it's so important because it's such a large asset usually on a merchandise business's balance sheet. Now we need to talk about how to tweak the actual accounting cycle for a merchandise business. And these are the steps, if you recall, in the accounting cycle. And you should now at this point know how to do all of them for a service business. All we need to change are a few journal entries, one additional journal entry, which is actually a type of adjustment. And then the financial statements are slightly different as well because they've got a cost of goods sold item. And that's about all that needs to change. And what you need to remember, one of the critical thing, because sometimes some of these new tweaks, the new changes that you have to do, students want to do them in areas where you don't need to do them. So you have to remember down here, these key ideas will help you make some of these help you not make some of these common mistakes or misconceptions. And the first one is remember that the accounting cycle, which includes all your journal entries, they're only going to be different from what you first learned when we went through it as a service business. They're only going to be different when inventory is involved. If inventory is not involved, then they won't be different. And some of the things that you have to do are because the goal of the inventory, the merchandise accounting method we're using, which is perpetual, the goal is to always keep the inventory value up to date. In other words, the value in the inventory asset account, as well as the cost of the inventory you have sold to generate revenue, it's always current and up to date with every transaction. The next thing you have to remember is, and this is another area where students will make a lot of mistakes, if you're buying stuff that sounds like inventory, it's not unless the reason you're buying it is to resell it at a higher price to try and make money, right? Otherwise, it's just supplies or something. For example, if you buy cleaning supplies for your business to clean with, they're supplies. But if you buy them because you're a wholesaler, and you buy a bunch of cleaning supplies because you're going to sell them at retail, you're going to sell them to customers to make a profit, then that is inventory. So it's the purpose of what you're buying. So if it's bought to resell, it's inventory. And then this one, when you ship, and this is a rule of assets. When you pay to have inventory shipped to you, it is part of the cost of acquiring the asset and getting it ready for its intended use. That is how you cost an asset. So shipping inventory to us is part of the cost of inventory. But shipping the inventory to a customer that has bought it is an operating expense. So those are sort of the three things to keep in mind when we go through whenever you're going through the accounting cycle for a merchandise business. You've only got 4 new accounts. One of them is obviously the current asset inventory, where you plop the inventory until it's sold. The next one is a sales returns. We tend not to, you could use it in a service business, but you tend not to. You tend to want to know what your returns are relative to your gross sales because it may indicate that the products you're selling, your suppliers are giving you crappy products and your customers are bringing them back. So we have a separate account to track that. That's a contra revenue account. This one, when the inventory is sold, it leaves this inventory current asset account and becomes an expense. It's a type of product expense, and it's called cost of goods sold. And then the last one is inventory shortage. Going through all transactions, you're supposed to know how much inventory you have. And if you go to the storeroom and count, that won't be perfectly accurate. It should be close with modern day technology, but inventory spoils, it goes missing, it walks out the door, right? People steal it. So inventory shortage is for the discrepancy when you actually go and do a real inventory count to see how much you have and compare it to what's in your books. That is a type of operating expense. It's part of the cost of selling inventory. So let's start with our first couple of journal entries. So here they are. We'll start with some very simple ones. The purchase of inventory. We're going to assume that the transactions we have are going to be for $100 cash, and we're not going to worry about dates. So first journal entry, purchase, and not just any purchase, because if it doesn't deal with inventory, remember down here, if it doesn't involve inventory, it's not changing. So it's not a purchase of anything. This would be a purchase of just inventory, and it would look like this. Pretty standard, not really anything new. You would debit the asset account inventory. If it was $100, it'd be for a $100 debit. HST recoverable will be charged on that, and that's 13%. And then if you paid cash, you credit cash $113 for the total, right? Nothing really new. Next one, other than the fact you have a new account. That's it. The next one, purchase return. So this is if you return inventory. Also, not that much new. I will point out that with all returns, sales returns and purchase returns, you have it's possible that it could be the transaction account could be cash, accounts receivable, or accounts payable. This has come up before this point in the course, but we're just going to clarify it again because lots of students always get confused by that. So this is what it would look like. So if it were for cash, you'd write cash. But if it's not for cash, it depends on whether we, the business, have paid for this purchase or not. So if we're not getting cash and we've paid for it, then it's accounts receivable. We're waiting to get our money. If we have not yet paid, it would be sitting there as a payable. So since we're returning it, we're wiping out the payable because we don't owe it anymore. So it is possible it could be any one of these three, depending on the situation. So you have to read the information carefully. Again, the rest of this is just the opposite of what's up here, right? The debits become credits and the credits become debits. It's just a return. So the next one then gets a bit trickier. Purchasing, and it's because of this concept, the goal is always to keep your inventory value current. So here's a purchase discount. So we're going to say 2% on total owing. And this is, remember, when we first learned about discounts, I said this, that it's not actually on the total owing all the time. That's not actually how it's done, but that's what we're going to do all the time in the entire course, just so you don't get confused, because it's not a tax course. Purchase discounts 2% total owing. So we buy $100 of inventory. We would debit the inventory account for a number you won't understand for a minute. So if it were $100, the tax on the $100 is 13. But you understand that is 13%. And we owe the total. So where did I get this number from? Well, let's start from the beginning. So the inventory, if we bought it and we didn't pay cash at the time, we would debit it $100, right? Because that's what we're buying. But what's happening is we're getting 2% off the total owing. Well, what would the total be if we didn't get a discount? It'd be 113. Well, what's 2% of that? If we multiply 113 by 2%, we get $2.26. That would normally be a purchase discount, right? We would do this, purchase discounts, all right? And we would lower the cash we had to pay to $110.74, right? And that would be the transaction. But the goal is to keep inventory's value current. So if when buying inventory, we got a discount, then the value of the inventory we bought is not actually $100. And we need to lower the inventory's cost by that discount. And so it would be $100 minus $2.26. So instead of using, and the short answer is instead of using the purchase discount account for purchase discounts on inventory, you actually use the inventory account. And that's where these values come from. So the inventory instead of $100 is reduced by the discount. The government doesn't care about your discount. It wants its full $13. And the total then owing to the business that sold you this inventory, your supplier, is the total of the two, which is $110.74. Okay, so if you bought it on account at first and then you paid at a later date, but still within the discount period, then it would look like this. So now, because we didn't pay cash at the time, so we're assuming we're paying at a later date, but still in the discount period, we would debit accounts payable for the full amount owing. We would credit cash, but not for the full amount. We're going to take the discount. So this is exactly the structure it was for a service business, except instead of crediting purchase discounts, we credit inventory to lower the value. So up here, we would have had a $100 debit and cash would have been, accounts payable would have been credited $113. So now we're lowering accounts payable $113 because we're paying it. And we're crediting inventory. And if it were 100 here, this credit would then bring the total value of the inventory we bought to this number, $97.74. Again, because we're always trying to keep the value of the inventory we have on hand current. So since we got a discount on the inventory, we lower the value of the inventory by the discount and pay the difference. Shipping costs, again, of inventory. To our business, we simply debit the inventory, not a shipping cost or delivery cost, the actual inventory asset account for the value of the shipping bill. So if it was $100 shipping cost, it would have HST, so it's HST recoverable, and we would pay, if we were paying at that time, $113. Again, if it's not inventory, it's just a shipping or delivery expense. But if it's shipping to us for inventory, it becomes part of the cost of the inventory. If it's to a customer, even if it is inventory, shipping inventory to a customer is not part of the cost of acquiring the asset, the inventory asset, and getting it ready for its intended use, which is resale. It's not. It's shipping the goods once they've been bought by a customer. That's different. So you debit some kind of delivery expense or shipping expense. It's an operating cost. Whereas buying it and having it shipped to us is part of the cost of the inventory. Shipping it out to a customer is not. Otherwise, the transactions are the same. It's just these two accounts that change depending on what you're doing. If it's coming to us, it's part of the cost of the inventory. Sale of inventory. This one here is actually your largest type of journal entry in the course. So let's do it from scratch, because it's actually easier if you do it in this order, I find, at least myself. So we're going to start with, so it's a $100 transaction, and you have to be told what the value of the inventory you're selling is. So from scratch, the first thing you're going to do is credit some kind of revenue account. It's usually sales or sales revenue. And that's going to be for the ticket price. So it's $100. That's what we charged. The next thing you're going to credit is, just as before, you have to charge HST, and you owe that to the government. So your customers pay you for the tax and you send it off to the government. So it's a liability to you while you hold on to the money. So you credit 13% or $13 HST payable. And then normally what you would do is you would then have collected cash, right? And the cash would be the total amount owed. So that's what it would have been. That's what it would have been like for a service business, right? That's how you know it so far. The only difference now is that, because if you recall, if I scroll back up here, our key idea is that we're always keeping inventory and the cost of selling inventory up to date. That means we don't have as much inventory anymore, right? If you have a sale, the inventory goes out the door with the customer. So you have to now credit the inventory account like this. And it tells you in the question that the cost to us, the business, of the inventory was $60. So that $60 worth of inventory has left the building. So you credit the asset account inventory to make it go down. And the value of that inventory has now become an expense. And you should know by now, we call that expense the cost of goods sold. And it's $60, the value of the inventory. When there's a sale discount, it's basically the same transaction. The only difference, as always with discounts, is the cash amount is reduced by the value of the sale discount. And the sale discount is always on the same side. The account is always on the same side as cash. So it's going to look like this. Everything is the same, except now, instead of receiving $113 of cash, we only receive $110.74, reduced by 2% of the total owing, which is $2.26. That's it. And this is the longest journal entry in the course. So if you understand it, you're doing well. Second last one. So sale return. A sale return is essentially taking a sale transaction. It could be either one, with no discount or with a discount. And then you have to reverse all of the accounts. So the debits become credits and the credits become debits. It's that simple. The only difference is you don't reverse sales revenue. You leave it so that you can compare your total original sales to how many returns you have. And in order to do that, you have to plot both those types of transactions into two different accounts. So this will look exactly the same. The payable debited, inventories debited where it was credited before, sales revenue was credited. We debit the $100, but not to sales revenue. Instead, we use the sales return account. Otherwise, everything's the same, except with this same concept that on a return, if you're not getting cash, then it could be accounts receivable or payable, depending on whether the customer's paid or not yet. And that's the same concept as it was for a purchase return. So that's it. Those are really the only journal entries that have to be tweaked or changed in any way. And it's because those are the ones that deal with inventory in some way. Anything else won't be any different. So the rest of these are done by a computer. They're no different at all. The only process that has anything else to tweak is adjusting, and it doesn't necessarily happen always during adjustments. It happens whenever you have an inventory account, a physical inventory account. You send your employees in, the store's closed usually, so it's after hours. They count all the inventory that's on hand, and then they reconcile that, compare it with what's on the books. And if there's a difference, then you charge it to an operating expense count called inventory shortage. So in this example, if your accounting records, so your inventory account says you have $20,000 of inventory, you go, you count, you check it, tally it up, and it's only $19,000 in the room, then your adjustment would look like this. You would debit inventory shortage for the $1,000 difference, and you would just reduce the inventory by $1,000 to bring it from 20 down to 19. That's all there is to that. The last thing then that changes is when you produce financial statements. Obviously, the balance sheet will have merchandise inventory on it. That's no big deal. It usually appears right after accounts receivable. But the income statement is a little bit different, and I have a little demo right here. So if this is the revenue section, you've got the actual account, cost of goods sold, right on there. You don't actually have to calculate it like you did in the last lesson. That was more for moving forward in business courses. You'll need that schedule of cost of goods sold calculation, know how to do that. But on a perpetual merchandise inventory, income statement is really just a line because cost of goods sold is an account. And every time you have a sale, you're updating your cost of goods sold value. So you just look at the account and that's your cost of goods sold. So I'm making these numbers up just for demos, but so if you had say $100,000 of sales and then you had sales returns of 5,000, you would show that as a negative because it has the opposite value of the revenue. Right? This is the revenue section. So anything that has opposite value of revenue items would be shown negative like that. So sales returns, and let's say you gave sales discounts of 2,000, that would mean your net sales is the total. So it's the 100 minus these other two items. So it'd be 93,000. And that's the number you use when it says net sales. And for bad debt, if it says net sales, then you use that. If it says net credit sales, it has to be the sales on account. But that's what net sales is. It's all your revenue minus any discounts or returns. Then from that, you would subtract your cost of goods sold. I'll make this up too. Let's say it's $40,000. And that leaves you with what's called gross profit. And quite simply, you can tell just from the formulas, gross profit is the difference between your sales, your net sales, the sales you are left with and owed, and the cost of the items you sold to earn those sales. And this is the profit margin here. It is what share of these $93,000 is this profit? That's your first and most important margin when you're doing financial analysis. So from the gross profit, you then subtract all of these other regular expenses you're used to for a service business, like advertising, salaries, property taxes, utilities, that stuff. And that essentially sums up the only things you have to change between the two methods of accounting.